US inflation hit its fastest pace in almost 4 decades last year as supply chain bottlenecks, demand imbalances and monetary stimulus all helped to keep price very elevated. In December, inflation rose 7%, up from 6.8% in November. That was the fastest rise since 1982 and marked the third straight month in which inflation exceeded 6%. The core price index, which excludes the often very volatile categories of food and energy, also climbed 5.5% in December from a year earlier, the highest pace since 1991. Now, prices for autos, furniture and other durable goods continue to drive much of the inflationary surge, fueled by pandemic-related imbalances of supply and demand that most economists, though, expect to fade as COVID-19's impact on the economic activities eases. Now, joining me now from London is Craig Erlam, OANDA Senior Market Analyst. Craig, thank you very much for being with us today. So the last time that we saw such an increase, it was in June 1982. But I mean, the environment was very different than it is today. What do you think the Fed response should be at this point?
Well, I think the most important thing is that there's no cause for panic. There is going to be some elements of this inflation data which is stickier than the Fed would have liked to have seen. And I think the most notable part of that is things like wages. We're seeing strong wage growth as per the jobs report last week, which saw it at 0.6% month on month, and much higher than we would typically see on an annual basis. So that's feeding through from a very tight labour market, which is being driven by a strong economy because the recovery from the pandemic has been so encouraging, but then also a reduced labour force, which we have seen more people drop out of the labour market, and therefore that's creating additional tightness in the market, and this additional fluidity that we've seen since the pandemic. A lot of people moving jobs is helping to create these tighter conditions and therefore higher wage growth. So I think that's one permanent aspect of this, or at least semi-permanent aspect of the inflation data, which is something that the Fed will want to regain control of. But there are still many temporary factors. We are still seeing supply side issues. One of the core drivers of the inflation data, for example, is used cars. The reason used cars are so in demand is because of the chip shortage, which is an ongoing problem. So that isn't going to last forever. So I think the Fed needs to remain calm, but a few rate hikes this year, I think, is going to be a sensible approach. And ultimately, that will only take interest rates in the US close to 1%. That's not going to be too damaging for the economy, but it will start to address what inflation issue there is.
Interested in, Craig, you just rightly pointed out that there have been two camps in the past year when it really comes to inflation, the transitory camp or the economists actually thinking this might be permanent. But in your own opinion, I mean, how much of this can be really attributed to transitory effects and effectively disappear once the pandemic eases and, you know, the supply chain bottlenecks will really go away, in your opinion?
So I think it's important to note that transitory almost itself falls into multiple camps, because you've got the transitory effects which will alleviate as soon as any supply side issues are eased. So as I've just noted, when the chip shortage abates, I expect that we will see used car prices falling. We'll see demand for new cars start to rise. So that's something that I think will address itself very quickly. But then there's other areas where supply side issues or where transitory inflation problems are going to last a little bit longer, but not necessarily become permanent. So this is where we do have second round, third round, fourth round effects, where it takes a little bit longer to fall out of the system more naturally. And then, of course, we've got those previously transitory pressures, which are maybe going to become more permanent. And then, of course, like I've just mentioned, things like wages, which are more a reflection of this kind of surprising tightness in the labour market, which didn't exist prior to the pandemic due to people dropping out the labour force. And again, part of that may come out over time once people start to return to the labour force, once we get more certainty and more permanence on things like childcare, for example.
And the great resignation, as we've seen. Craig Erlam, many thanks for being with us today.